Rightio, welcome back to the Williams Real Estate channel. Today we are running through the monthly market update, property market update for May 2025. So we saw out of CoreLogic the annualized growth rate for the month of 0.5%, 0.5% across the board. Pretty decent month. Uplift, probably because of the confidence now coming to market as we saw the rate cut. So I can feel it already. Confidence is back. People who are probably been sitting on the sidelines have decided to start jumping in, and it's already starting to be reflected in the broad-based expansion as every capital city saw gains, strong gains throughout the month of May. Leading the month was Darwin, followed by Perth and Brisbane, and the rest of the metro markets coming in pretty well strong with 0.4 to 0.5%. So strong month. If we look at it at an annualized basis, we will see that over the last 12 months, Perth and Adelaide have outperformed with 8.6%, followed by Brisbane with 7.1% over the last 12 months, followed by Darwin, 3.9%. Darwin's starting to pick up a bit. And then with Hobart with only 1% and Sydney 1.1%, and Melbourne and Canberra in negative subdued territory of 1.2 to 0.7%. So strong markets still coming out of Brisbane, Perth, Adelaide, and the combined regions. If we look at a combined level over the last 12 months, we have seen 5.3% out of the combined regions and the combined capitals with 2.6%. So the likes of Sydney, Melbourne, Hobart, and Canberra pulling back the average. If we now look at what the home value index looks like as of May 2025, we will see that Sydney is, of course, number one most expensive capital city with a median price point of 1.2 million, followed by Brisbane with 970,000 median price point, then Canberra at 855,000 price point, Adelaide at 829,000, then Perth at 813, and Melbourne at sixth place, 791. Screaming value. Melbourne, that is. Hobart, 673,000, and Darwin, 525. So also pretty good value in Darwin, I would say. But yeah, best values we're now finding are across both Sydney and Melbourne. And we are no longer looking in Brisbane, Perth, and Adelaide, as those markets have had a solid run in recent years. We use the 18-year land cycle. I'm sure if you've watched me, you see me harping on about this. This is one of our key fundamentals when buying property, is timing based off this 18-year land cycle framework and studying the historical sales data to work out where each market sits based off the framework, based off historical trends at a macro level. We then obviously dig deeper into further micro factors as well on the ground. But looking at a high level, macro level, we are on the blue marker. 12 to 18 months away from peak. Let's say 12 months away from peak market to 18 months. Come 18 months to 2 years. By 2027, we are due for the next land-driven downturn They'll call it something. I'm sure they'll call it the Trump tariff collapse or something along the lines of that. The Great Reset, which will be like the likes of 2008 GFC and even better, the 91 recession we had to have. So we use this as a framework. We sit now on the blue marker, and as you'll see as I go through these slides, you can visualize how each market will perform in the future years ahead based off historical sales data as we sit now equivalent point of time in 2006 in the price cycle. So we'll run through these and you'll see that the markets perform in these segments as the cycle plays out. So starting off from the booming markets to the more suppressed markets. Darwin would be on the agenda for a booming market. As you can see, we are in 2025 and it's starting to trend up. It is getting a lot of traction from investment. Like what happened in 2006-07, it continued to boom up until around 2013. So if history is to repeat, Darwin could see a similar growth pattern. The only caveat I would say is this time round, China is not as strong. Their economy is quite weak. Their property construction industry is not booming like it was pre-GFC and throughout the GFC. So a lot of this historical growth was thanks to China pushing our or drawing on our industries in the mining sector, buying up a lot of our coal, iron ore, coal seam gas that was funding or going into their property and construction industry. This time round, China's not as strong and they've got a lot of pressure from the US. So Darwin may not experience the same boom it did between 2006 to 2013. For that reason, we aren't focusing on Darwin. There's better markets to invest in, more diversified markets, less dependent on the mining sector that don't go through these significant boom bust. And this time round, yes, it is starting to pick up a bit, but it looks to have stagnated again. So it did run in 2020, 21, and history doesn't repeat exactly, but it rhymes. So it won't, in my opinion, continue to keep booming like it did because the mines aren't going as strong as they were in the prior cycle. So Darwin may well be hitting a limit and starting a more stagnant, subdued growth. But time will tell. No one really knows because it has that dependency on that mining sector. So anyone's guess really, but for our liking, it's not one of our markets we like to focus on. Obviously, we like to keep an eye on it, keep tabs on it, but at this stage, it is not on our agenda. Adelaide is hitting a top, as you can see. It is hitting its limits, showing signs of a top as it has come off a strong bull run of over 100% in the last couple of years since 2020. And if we look back at history from 2006 and onwards, it then topped out and went through a more stagnant, flat period. So that's what could be expected for units in Adelaide for the coming years. Same goes for houses in Adelaide. Looks to be losing steam and looks to be showing signs of a top, just like what happened in 2006 and 7, reached its limits and then went through a more stagnant, flat period for a good 10 years. So again, Adelaide looks to be showing signs of hitting its limits. Perth units has come off a low base and boomed in recent years as from 2020 and has looked to have now gone up 100% if we're looking at the median price point for units, and looks to be showing signs of losing steam and hitting a top, just like what happened in the prior cycle of around 2006. It went through a similar boom, 5 and 6, and then hit a top around 2006, 2007, and then switched off and went through a protracted up and down, stagnant, flat to negative period. So again, a region we are not looking at this time of the cycle. Houses, again, in Perth, looks to be showing signs of a top in recent months after its significant boom from 2020, trough of around low twos to now mid fives. So again, has gone up over 100% in this suburb that we keep tabs on. And just like what happened historically, again, had a boom in 2005 to 7, topped out around 2006, 7, and then went through this subdued negative growth period for many years, over 12, 13 years. So another market we are not looking at this stage. Brisbane units is also showing signs of a top, starting to lose some steam, and will top out in probably the next 1 to 2 years, just like what happened historically from 2006 and 7, and then is due to go through another stagnant, flat period. Same goes for houses. Houses look to be losing some steam, still have growth, as came off a median price point of just under 300 and is now hitting over 600. So has gone up 100%, probably has a bit more growth left in the tank, but will flatten out over the coming years and then go through a more subdued, flat period for Brisbane houses. Canberra units had a solid boom from 2020, 2019 to 2020, all the way up to 2022, topped out, then went through a downturn and looks to be continuing that downturn and hasn't yet showing signs of stabilizing. Probably will stabilize in the next 6, 12, 18 months or so. Time will tell. Keeping tabs on it. And the stagnant period will stabilize. Sorry, the stabilization of the market will then go stagnant for probably not as long as the other markets around Australia as what happened in 2005 and 6, and then had another growth run from 2007 to 11, which it then topped out and then went through a later stagnant period. So a bit of a volatile market, Canberra, but looks to be showing signs that it hasn't reached a bottom yet for units. Houses, similar story, but looks to be showing signs of stabilizing. Topped out in 21, 22, started its downturn, has since come back a bit and may well continue this $1 million range for a little while. But houses are a little bit more stable than units down in Canberra. So the stagnant period won't last too long before it will then commence another modest growth cycle in the coming years. Hobart units has topped out in 21, 22 after its growth run, retraced in 21, 22, 23 in its downturn, and is showing signs of stabilization. So looks to have probably found its trough and now starting to stabilize, and will go through a stagnant period. Historically, from 2006, 7, had some growth, but then lost it again down to 2015. So we could expect that units in Hobart to maintain within that 5 to 550 range for a good 8, 9, 10 years. When we're talking houses, houses in Hobart also topped out around 22, went through the downturn and looks to be stabilizing as it's come off a trough of 600,000 medium price point, and will probably stabilize and go stagnant for a good 10 years, like what happened from 2005, 6, all the way through to 2015. Could be what it will look like in the next 10 years for Hobart. Sydney units is or are in certain markets, certain suburbs, stagnating. Great time to buy. We are buying in Sydney if we can get the right deal. We're buying in Sydney for sub 450, even as low as 350. So you can get the right deal. It makes sense now, even though the market hasn't started to kick. We'll continue to stagnate within this 500 grand range for probably another 18 months, 2 years, depending on what suburb you're looking at. Some suburbs are slightly ahead of this current suburb, but on average, another year and a half to 2 years of stagnant growth, just like what happened from around 2005, 6, all the way to 2008. Come 2008, when the market turned, the ripple effect came back from the regions, from Brisbane, Perth, Adelaide, and their respective regions, and Darwin. That demand shifted back into Sydney, and Sydney took off in the first half of the current cycle. So that's why we're sowing our seeds now in Sydney, in certain products, in certain suburbs, as it is coming to the tail end of its stagnant flat period, and it's getting primed for its next growth run, just like what happened from around 2009 all the way up to 2017. Solid boom for a good 7, 8, 9 years. That's for Sydney units. We're super pumped on Sydney units at the moment. We're seeing the great value. Houses, not so much the same story for houses at this stage. Houses have had a decent run in recent years and historically went through a pretty stagnant flat period from 2005, 6 all the way to 2013. So we are not super excited on houses in Sydney at this stage. We will keep tabs, but for $1 million, 800 grand, 900 million bucks for a house, you can go buy a decent block of units in the regions for that and get a better return. So houses in Sydney, sub $1 million range. There is, I guess, value if you can compare it to the eastern suburbs, but you can put your money to work a lot harder in better markets across the country. But Sydney houses have been going strong the last good decade and could be on the cusp of a stagnant flat period, just like what happened historically. Melbourne units. We have been active in Melbourne, buying deals in Melbourne in certain suburbs, certain products, certain price points, as Melbourne is stagnating, if not already bottomed, arguably probably starting to go up. I feel last year the deals were probably the best in 2024. This year it is showing signs of green shoots, just like what happened from around 2006 and onwards. So Melbourne's primed for its next growth run. In units, houses, similar story, but probably a little bit behind the units in Melbourne, where houses are stagnating and will continue to probably stagnate for another 12 months, 18 months before starting a growth cycle. But again, houses, price points around that, 700 grand mark. I'm not a super fan of buying houses in the metros. I'd rather stick to individual units and blocks of units in the metros. You get better value. And we like to buy houses in the regions because for the same price of buying, say, one house in a metro market, you can go buy a block of 3 or 4, 6 units in a region. So I would rather buy a decent block of units with a cracking return with development upside to either strata title or redevelop than parking that same capital in one house. So something to think about, but Melbourne houses are primed to run in the future years ahead. And this is a summary snapshot of where I see each capital city sitting as of May 2025. Slightly updated it since last month. I have changed the terminology slightly. If you are paying attention, we have Adelaide hitting a peak. I see Adelaide topping out, followed by Perth will top out in the next 1 to 2 years, and Brisbane again, 1 to 2 years. They're in the midst of the FOMO. All the stupid money is pouring in, and then goes to Darwin. So prices are rising in Darwin, but it can be anyone's guess. As I said before, China is definitely not as strong this time round, and a lot of that growth that was received in Darwin was thanks to the mining sector pumping, which was thanks to China buying up like crazy to build all their construction property industry boom back in the price cycle. So it's not there. I don't believe it probably could be hitting a top even earlier, but it will get a lot of the stupid money now, as everyone seems to think it's a good idea to keep rushing in. Another thing I'll note on Darwin, which I'll do a future video on to explain a little bit more about Darwin and why I don't like necessarily buying Darwin, because Darwin is at a high risk. And you may be thinking, I'm crazy, but if all World War III broke out, which I'll do a separate video to explain why I think it could happen, it's all cyclical. If it did, which the probability is higher than in recent decades, we could see Darwin getting hammered. So just like what happened in World War II, the Japs were firing missiles into Darwin. You can imagine what would happen to Darwin if that happened again. Darwin would go through a significant downturn. So Darwin could be anyone's guess. It's like playing roulette. China's not there this time round. The risk of a war is increasing. And if World War III broke out, Darwin's at risk. So I'm not a super fan of Darwin for those couple of reasons, but I'll do a further breakdown in future videos. So stay tuned. We see Canberra and Hobart. They've gone through their downturn from the peak in 2022 and are starting to stabilize. Canberra probably still has a little bit to downturn before it'll reach its trough and stabilize. Hobart looks to have stabilized and will start to stagnate in the coming years. Sydney is stagnating, flatlining. Melbourne has stagnated over the recent years and and I feel it is coming to an end of its stagnant period, and I believe it's at the bottom, if not already probably past, and could be on the way up in the future years. So that's a summary snapshot of where I see each capital city sitting as of May 2025. And as always, this is by no means financial advice, as I am not a financial advisor. But if you want help getting in the market, building a portfolio, scaling to the next level, and joining the 1% of Australians that have 6+ investment properties, don't try and reinvent the wheel. I've got a blueprint I can send you. Shoot me an email. I'll send you my roadmap. It consists of the Williams real estate investment strategy. We like to buy units in the metros with strong yields. We then leverage the growth out of the units into regional houses with the development upside. Once you're into a couple of units, villas, townhouses in the metros, and a couple of houses in the regions, we then move on to a duplex, 2 units on one site. Once you've got a duplex, we then leverage into a block of units. Then you have your solid residential portfolio, 10 in 10 years, 10 within a 10-year window. If you're on 50, 60, 80, 100 grand, if you're on 200 to 500 grand, you're shit it in, you do it within 5 years, easy. So that's the blueprint. If you want to get to a 10 property portfolio, I'm also working on part 2, which for all the big shots that hit 10 properties and they're looking to go from 10 to 20 or 30, which is what I'm doing currently now, is reinvesting these smaller deals into larger deals such as blocks of units and then boarding houses and ease into commercial. I'll be sharing a part 2 portfolio blueprint that I'm currently developing. But our key fundamentals to buying property are buying under market value, under the intrinsic value, so at least half of the replacement cost. Strong yield, minimum 5% yield, and everything's between 6 to 8%, depending on the property, in the location, condition, but everything's between 6 to 8, but minimum 5 is our cutoff. We don't look at anything less than 5. Growing population in a suburb and a region that will gentrify over time. So getting into these suburbs that are rough and ready around the edges, but will flourish due to the amount of capital investment that's coming from the public sector, which then spurs on to private investors to start buying up sites, redeveloping sites, renovating houses, opening up bars and restaurants. These suburbs will flourish over time, just like what happened to Redfern, Surrey Hills, Bondi Beach, Balmain. These suburbs, if you get into the suburbs, equivalent point of time today, then like those suburbs that have gentrified, you can get good deals, they cash flow well under the intrinsic value, and then they'll gentrify and flourish, and you'll get the capital growth compounding over the future years ahead. And the fifth and final, obviously, off the back of this video, you'll see that we use the 18-year land cycle as our framework to invest in property. It's the underlying cycle. It's the most powerful fundamental, I believe, to use. Market timing is key. Getting into the market, getting a great deal towards the tail end of a stagnant flat period, when it's primed for growth, the market will do 90% of the heavy lifting. So if you can get the right product at the right price at the right time, you pretty much don't need to do anything. The market will do 90% of the heavy lifting. Sure, you can do renovations and development to complement your investments and your sites to boost values, but ultimately, if you can time markets well, you'll make a killing. So I can help you do that. I've been studying this for many years. And if you want help, shoot me an email and I'm happy to run reports of your existing portfolio, because you've got to move and shake. If you want to build and grow, you at some point will need to let properties go rather than holding them through their stagnant flat period. So we can jump on a strategy call, pull apart what you've got, see where you're at to get you to the next level. Or if you're starting from scratch, happy to help you build the 10 in 10-year portfolio. Until next time, thanks for watching.